Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. We had a chance to sit down recently with Blue Owl co-CEO Marc Lipschultz at their Nest Network Summit for RIAs and private banks in Laguna Beach. It was a perfect setting to discuss Blue Owl's incredible growth, which has been in part due to their unique and focused partnership with the Wealth Channel. Blue Owl is one of the industry's largest alternative asset managers and has charted an impressive growth path in the 9 years since their founding. They've scaled to over $250 billion of AUM and have proven to be one of the top firms in raising capital from the Wealth Channel. Marc is a private markets industry veteran who has been instrumental in building not just one, but two of the industry's biggest players. He spent over 2 decades at KKR, serving on the firm's management committee, and was the global head of energy and infrastructure after joining the firm as one of the first 20 employees. He then partnered with Blackstone GSO founder Doug Ostrover and Goldman Sachs partner and co-head of leveraged finance Craig Packer to co-found Dyal Capital Partners, the predecessor firm to Blue Owl's credit platform. Owl Rock combined with Dyal Capital Partners to become a publicly traded entity, Blue Owl, in May 2021, and has since grown to over $250 billion in AUM and $2.2 billion in revenue. Owl Rock, and now Blue Owl's flight, is emblematic of the evolution of alternative asset managers. Marc and I had a fascinating conversation about how Blue Owl's growth highlights trends that have propelled alternative asset management into the mainstream. Scale, a focus on private credit, data centers and digitalization, a focus on private wealth, and the power of permanent capital. Thanks, Marc, for coming on the show to share your wisdom and expertise in private markets.
We're going mainstream.
Marc, welcome to the Alt Goes Mainstream podcast.
Thank you. Very good to be here.
Pleasure to have you. We're in such a fascinating setting. You're here in Laguna hosting a number of firms in the wealth management space. I think that's so emblematic of many of the things you've done as a firm and your focus on the Wealth Channel. So I certainly want to get into that as we talk all about business that you've built, how you're thinking about working with the Wealth Channel. But first, I think really helpful to start with your background. You have been in private markets for a long time. You're very senior at KKR. You've done it once, now you're doing it again. So tell us kind of how you got to building Owl Rock and then Blue Owl.
It is an interesting setting to have this conversation, and you've been so deep on the topic of wealth management, how it meets the private market. So I love to have this chance. So wealth management, which of course we'll come back to, has been bedrock as a part of our firm from day one. And I'll come on to that. But of course, that itself starts much longer ago, to your point. So I've been in the private markets business for 30 years now, which is sometimes hard to say out loud and contemplate. But I started at KKR in 1995. And at that time, the alternatives universe, first of all, we didn't use the term alternatives. It was just these kind of exotic investment strategies. And we didn't have the word private equity. We were an LBO firm. And when I joined KKR, we had 20 total professionals, front, mid, and back office. And of course, the business was focused on a very small number of institutions. So there's certain resonances for sure, as you know, which is you go back to that moment in time and you had 2 LBO firms of any scale. You had KKR and Forsman Little. These other firms that today, are, of course, are Goliaths, were startups, if they existed at all. And the investors, much like the wealth kind of composition looks like today, was a small group of power users and a lot of people that didn't use it at all. And that's kind of where the journey for me started. And during that, I spent 21 years at KKR, and I was really fortunate to be part of an incredible firm at this incredible evolutionary moment where we went from that couple of boutiques, couple of power users, to alternatives, now let's just use that term, alternatives or private markets becoming a multi-trillion-dollar industry. And to have a front row seat to that and play my own part in it was really exciting. And again, it was good fortune more than anything. But I did private equity throughout that time and started an infrastructure business and some other businesses and served on the management committee. And we went from being a very secretive, albeit very well known firm in 95 to becoming a public company. Of course, they're an even larger global enterprise now. But when I left to form Owl Rock, predecessor to Blue Owl with Doug Ostrover and Craig Packer, the opportunity then from our point of view was to say, well, now there's this multi-trillion-dollar world called alternatives, and we can build a business serving them, and we can build a business that is going to serve institutions and individuals as true peers in that journey.
So many things to pull out in there. I want to start with the concept of growth. You saw growth at KKR. You're now seeing growth at Owl Rock and Blue Owl. I think recently in your earnings report, you showed how much growth the firm has had and across pretty much every key metric from fee-paying AUM to revenue to stock price to employee number. You've grown like 3 to 4 times. And when you think about that, that's a high growth company. What do you think you learned from your time in the early days of private markets, which has certainly grown where it is today, that you've been able to apply to the business?
2 things that come immediately to mind, and definitely things that I learned in my journey at KKR and working with, Henry Kravis and George Roberts are incredible. Incredible investors, that's obvious, but incredible human beings. So, I got to learn from the best. 2 things. One, the preeminent importance of culture. I don't think you can build a durable, successful investment firm without having a strong culture. Now, there's different kinds of cultures. It's not one size fits all. But when we set out to create Blue Owl, we had a very clear view about the kind of organization we wanted to build, the kind of organization around mutual respect, and that's both an internal and external idea, around constructive dialogue. People need to speak up. We need to do our best to come up with the best answer for our investors. Excellence. If we're going to do it really well, or don't do it at all. And one team that we are all in it to serve one end, which is going to bring me to my second point. We ultimately work for our LPs, our investors, a lot of different terms, but the people that entrust us with their capital, that's who we work for. And we have a job. Our job is to do everything we can do with our team and our knowledge and our capabilities to deliver on the expectations they have of us, outperform, preferably, but make sure we meet their needs because look, they're counting on us. These are people's retirement savings. These are people's nest eggs. These are pension funds. Then policemen and firemen are counting on the proceeds. And I don't say that like it to sound either overly high-minded or overly philosophical. Having an eye on who you really work for and what they're expecting of you, to me, and delivering results is part 2. So great culture allows you to deliver great results. Great results yields growth. Growth isn't an input to me. Growth is an output.
How do you operationalize that concept of culture when it comes to making sure you're connecting that to the investor and the outcomes that you're helping provide them?
So culture, from my point of view, again, needs to be, it's kind of a consistency, which is to say that it's not, well, here's how we think internally and here's how we think externally. It really is this idea, and let me again use mutual respect, this idea that that's how we operate with each other. That's how we operate with the professional service companies that work with us. That's how we operate with every one of our investors. There's simply no room in our world, the no jerk policy. And so I think the way we operationalize that is by living it consistently. First off, it has to be authentic. One thing about any culture, it's only going to work if it's really endemic, to who you are and you really believe it's true. And I do. I really believe that there's power in having great people working together and in fact, like enjoying it. And I'm not pretending that, work is supposed to be every day a party or like every day is fun, but every day can be meaningful. And certainly every day can be, I like the people I work with. And again, I mean that both internally and externally. And having that level of respect, I think is what allows us to operationalize it amongst our team, but equally importantly, with each one of our investors. Again, we work for them. We've been successful because of them. There's nothing so great about us, we've been lucky. We built a really great business. but it's because of them and the results we've delivered.
You say something that's really important in the context of the story of Owl Rock and then Blue Owl, which is we've built this because of them. One thing you've done from the outset and different from many other firms in the alternative asset management world, particularly at Owl Rock, was you focused on the wealth channel from the outset. Why?
So I'll flash back 10 years to roughly the inception of Blue Owl. And there were a couple observations we made. Most importantly, now let's just talk about it as a business matter, this idea of democratization of alts, which is an overly fancy sounding term and frankly even a little self-aggrandizing, but this idea of, hey, how can we bring new clients to this business and do right by them, which will do right by us. Again, it wasn't a selfless undertaking, or maybe put another way, I fully subscribe to the idea that you can do well and do good simultaneously. So yeah, I do actually, I really do get satisfaction out of knowing we're helping individuals meet their goals. I really do. But it's also a good business. So what we said was this. If you looked at my own 20-year experience prior to starting Blue Owl, it was all about the evolution of alts from a niche part of institutional portfolios to a core driver of their success. Why have pension funds and endowments and others done so well now for decades? And they've done it because they've had intelligent use access to private markets as part of a well-managed portfolio. And that happened for institutions over that 20-year period. So then when we started Blue Owl, we said, well, again, do well, do good. Hey, we ought to bring that opportunity to individuals because that is a big addressable market. To do that, what we really believed with a lot of conviction was you had to, A, invest in the people to support it. You can't just say, oh, I want to serve individuals, I'm just going to treat them like they're an institution. They're not. They have different needs, different expectations. It's a different infrastructure. And so from day one, we invested heavily in having the team and the best of breed people to meet that need, a culture, which we've talked about, that says, hey, look, we have a lot of respect for, admiration for these individuals. Like, we owe them. We have to earn their trust. It's not, oh, look, I serve institutions and maybe I can deign to be bothered with serving an individual. Like, that's the exact wrong mindset. And then really importantly for us, really importantly structurally, was this observation. For those who had started to serve individuals, it was observable that in most cases, what that was someone putting a brand or a title on a product and then delivering something totally different from what the institutions were getting. Nobody needs that. So our model from the beginning was individuals, the main thing they want from us is the same investment experience that our institutions are going to get. So we built our firm from brick one with this idea that individuals and institutions are peers. We are built to serve both, and we're built to make sure that we meet their needs, but they all get access to our best investment ideas.
I think that's a really important point when thinking about the wealth channel is they want that same experience. Now, it's easier said than done, right? And
For sure.
I think that gets to some of the building of the firm from the early days. How different did you have to construct the firm? Because there's not just pre-investment, but there's post-investment on the operational and client servicing side. There's the educational piece. There's so many aspects of working with the wealth channel that are so different. And I think that we'll talk about scale later on, but I think that make it much easier for certain firms in this industry to be able to serve the wealth channel than other firms. So what did you do differently when it came to actually setting up the firm? Did you have more people focused on wealth? How did you help investment professionals understand what it meant to invest for the wealth channel? Because maybe they needed to think about investing differently, maybe you need to think about new product structures in different ways.
Yeah, I think you've touched on some really key components. So let's start with the baseline. You have to make a decision. You're going to put a lot of resources and invest ahead of the opportunity. And I suppose like any new market, early on, there's a lot of uncertainty about that. But we did. We made an early decision that we were going to commit to having, again, an overbuilt team in terms of capability and just sheer number of people to support delivering the right product with the right, as you said, operational support, the right information. Today, we have 125,000 investors. Alts firms were never built for that before. And so you did have to build the backbone to go with it. So, well, of course, one of our earliest partners that helped build this firm from day one, Alan Kirschenbaum, was the CFO of TPG. So we had Craig coming from Goldman. I came from KKR. Doug had started GSO and then sold it to Blackstone, come from Blackstone. We had Alan from TPG. And the idea was to take, those are incredible firms. They were then and are now. But to take the best of what we had seen, but then create our own business model around a focus on private capital solutions that are more about lower volatility, risk management, private credit, GP stakes, triple net lease now as the business has evolved, but also we're really purpose-built to serve the individual investor. And that took also not just an investment in the wealth platform and having from day one, that be a big part of the firm, integrated into the firm from day one, but also having the operational capability. And part of what Alan and we all did was we said, we're going to build a backbone of quality that any institution would say, well, that's as good as any I've seen. And we're going to build it knowing that we want it to serve individuals and therefore has to be more scalable. Again, clean sheet of paper allows you to do that from the ground up.
One thing that's really interesting there that Sean Connors said this when he came on the Because Mainstream podcast a while ago was that you have 3 different business units from the investing side, GP Strategic Capital, real assets, credit, but you have one unified platform on the wealth side and operations side. That seems from a DNA perspective very different from many firms. How did you think about and conceive of that? Because that also enables you to continue to expand your platform as you've done with other acquisitions, but they all benefit from the shared services.
It is a great observation and a very important part of our firm, which is our wealth platform, our team of 140 people and growing today. Again, we understand our job. Our job is to partner with financial advisors and to work with them to say, well, what needs do you have and how do our products marry with those needs? And again, to have more the view, we're not trying to sell you a product. We do think we have a lot of really good products for individual investors, but our job is to provide that education to the FA and the partnership and then say, well, what fits? Because not every product is right for every person. I'm not one of these people that says, well, every single person ought to have their whole portfolio in alts. That's silly. I mean, a well-constructed portfolio is tailored to the person and their needs. So for us, what was important was to say, well, that's a unified question, which is we're going to be a strategic partner. And we've been very lucky to be partners to, the very best wirehouses and the very best RIAs and independent broker dealers. And it's their capability married with ours that is really the solution. But we want to be, again, a one-stop shop, easy interface for them. They know who to talk to. And if they have clients that are saying, well, I'm in a high tax state, so I'm much more tax sensitive. Well, that might lead them to certain real estate strategies. Well, I'm looking to manage around interest rate risk. Well, that might lead them, of course, to private credit. Or, look, I understand private markets are growing. How can I participate in the GP role? Looks like it's a pretty good business to be a GP. Okay, well, then that's GP Strategic Capital. So our job is to help kind of make those marriages. And that's why we've built it the way we have.
How do you balance being bespoke to the end client? Because as you say, different clients have different needs with being this one-stop shop. Because we're seeing this one-stop shop theme continue in private markets. Firms are getting bigger and the scale helps and matters. And I'd love to hear your perspective on that. But balancing those two things seems like it can be, there's both benefits to that because you add other platforms and strategies. And I think you've talked about how you've added all these different strategies or specific businesses, Atalaya being one example, Oak Street being another example of IPI in the data center space. How do you think about the interplay between those two things? I think it's an interesting, you need to be a one-stop shop to be able to serve everyone. But then how do you create more bespoke, customized solutions for even just the wealth channel has so many different stripes and flavors within types of clients you have?
Yeah, and I think they're there's a balancing act in there because here's another thing I would say about, I talked earlier about culture and product. And the other thing I should say, which probably marries to the culture point, is look, I think organizations have DNA. And I think at the end of the day, you do have to know what you're good at. And so on the one hand, the one-stop shop in the way I mean it is largely about trying to optimize the benefit of saying for a user of capital, their propensity to want to come to me first, last look, pay us more because they like the partnership. Like that's the value in the one-stop shop for someone using our capital. For someone investing with us, to a degree, the one-stop shop is, look, I know and I understand the products, and it would be productive for me to have maybe more than one thing we can do together. However, there is a balancing act. It is not our strategy at Blue Owl, and there are different strategies. We're not trying to be all things to all people, because this will tie back to this DNA point. I don't believe you can be good at being all things to all people. I believe that you're right. There's this exercise we're always going through, which is how do we take best of breed investment capabilities and make sure that everyone who's got their day job says, I'm waking up and I am thinking about how to deliver the best results for someone in our asset-backed lending products, the best results for someone in our digital infrastructure product, but marry that with a culture and a firm that says, well, the best results will come from all of us cooperating to drive, for example, originations across the platform, to drive this idea of sharing intellectual capital. If you have knowledge and you share it, that didn't hurt your LP base, and the corollary sharing will help your LP base. So I think there is a bit of this, how do you keep, and this is what we've tried to build, either organically or through acquisitions, people that are the best at what they do, but then marry them to a culture that says, but we're one team. So again, culture is going to show up. And then what I would say, maybe adding to that operationally, is seeing synergy, again, as more about origination and intellectual capital. It's not about costs. In fact, when we acquire business, we generally think we're going to put more money into it. Many of the entrepreneurial businesses actually tend to run thinner than the way we want to with the resources behind them. So last, to wrap this thought up, the problem with trying to be all things to all people is like in a DNA imprint, I think you have to know what, so we really focus on downside protection. We focus on stability, income generation, generally inflation protection, and that wires like our mindset and our processes and our infrastructure and our teams in a way that's focused on delivering that kind of base result for an investor. I don't really believe that as a general matter, and maybe with rare exception, although it'd be hard to point to it, people can be really good at something like credit, where everything is about you get your money back and a coupon or you lose money. Those are the outcomes. Marry that to venture capital, where one deal makes the whole, 5 go away, and 4 are okay in between. It's a completely opposite mindset on decision making. And I just don't think organizations, it's why we don't see them cohabitating or coexisting. You can't be, I'm about seeking the gem in the rough, and I'm about being right every time, and just switch on and off. I just don't think it works.
Interesting point, because there's two both intersecting but competing points within that comment, within the wealth channel in particular, right? And I think we're even seeing this in the institutional space too. Many firms are starting to be able to cross-sell the investment products or strategies that they have, and LPs are now investing across different platforms or strategies, because LPs, they want convenience in a sense. They want quality, but they want convenience. Yep. And marrying that with what you just said, I think it's a really interesting question around brand. So how do you think about brand in the context of what I just shared about brand matters, and that to some extent will drive how people think about the firm and why people decide to work with a certain firm. But then also the other side of that is you can't necessarily be everything to everyone.
Yeah. And this brand topic, I think, is a topic for the industry writ large, because for obvious reasons, I mean, brands by definition are supposed to stand for something. And of course, we want ours to stand for trust and like and respect. I mean, that's the relationship we want to have with our investors and what we want our brand to mean. But importantly, our brand in our mind does mean strategies that share those attributes I described. It doesn't just mean we do alts. And by the way, someone could say my brand is I do alts, but what does that really mean to the user? Again, I'm about the end result for the investor. Alts aren't an end state. Alts are a methodology. Alts are a path to get a result. And by the way, not the only path. They're part of a holistic path. So you could have a brand that just means I'm all about alts, but I'd prefer to have a brand that's about what matters to them, which is the results. Our brand, we like to think, and I don't want to overstate it, we claim, we're not Coca-Cola, but our brand, we hope, connotes to people something about focus on performance, about downside protection, about earning income, about reliability, about transparency, about that experience, whether institution or individual. And that's what I agree with you. There is this, people want the convenience and comfort of a brand, but they want the results as a result, not just, oh, that's neat to be invested with that company. And the thing that the industry, I think, is facing, will face, is a little bit of like brand. People get a little weary of, well, I don't really want a ninth product by company X. And so I think there probably is a bit of this balancing act, and it probably reflects an underlying idea, whether people say it or not, that I just know explicitly or intuitively, there's just no way you're going to be good at everything. So there has to be a coherence to the products you're building and what that brand therefore means.
How do you think that'll manifest itself in terms of what are on a lot of CEOs and executives' mind, which is build, buy, or partner as an alternative, or even traditional asset manager?
So for us, we start with, where is there an opportunity to deliver an excellent risk-adjusted return, again, with a particular emphasis on risk management. Okay, we start there. That will lead to, where are there places where a couple of attributes show up? Most simply put, where is demand for capital high relative the supply of capital, or at least the properly constructed supply of capital? So that'd be one, just simple supply demand. Where are there disconnects there? That's an opportunity potentially. Then to us, is within that opportunity, is there a way to earn returns for something other than just having the capital? Because if all you're doing is competing on cost of capital, I mean, it might be a perfectly fine result, but it's pretty uninteresting. So we're always looking for places where people care. Of course, they care about the capital itself. Of course, they care that it's priced within what they would deem reasonable for their business. But we want, in every instance, is someone who also says, but I care who I get it from. I care who the partner is. So if I think about our triple net lease real estate business, and you think about some of the biggest, best credits in the world, the Microsofts, the Amazons, of course they can work with anybody they want, and their cost of capital could be about as low as they want it to be. But who they work with matters to their strategic ends. To build a bespoke hyperscale data center today, you need a lot of skills, and you need to be a very reliable partner. We said, okay, mismatch of capital, clearly more demand for hyperscale data centers than supply. And there's only a few people in the world that have true demonstrated expertise in, I can assemble the land, the power, the cooling, and build to your spec and deliver on time, and then operate it for the next 15 years the way you want it operated. IPI was decidedly one of those, and I think the best of them. And therefore, we said opportunity, capability. You can't build this organically, but what a great low risk, very return income oriented with cap gain upside strategy. So we acquire an IPI and marry that into our fabric.
So I think what you're getting at is a really interesting point around scale. So I want to touch on that in two different conceptual frameworks. One, why is scale so important in private markets to accomplish the things like you just mentioned around data centers? And you're playing in a space where more capital is required. So how do you think about the concept of scale in that regard?
So I think scale is a meaningful advantage in some markets. And scale, nothing comes for free, right? There's always going to be trade offs. I think there's probably businesses where scale is not particularly an advantage. Again, I'll just use the same example. Like in venture capital, it's not at all clear to me that things scale. It might be a disadvantage. And I'm not pretending it's not my area of expertise, but it's apparent that some of the most successful venture firms are still pretty small and pretty focused and very, very kind of built around the individual practitioner. So scale is not necessarily a good thing. Now, in certain markets, it is. And I think it is for a few reasons. One, it gets down to information and knowledge and being able to invest heavily in knowing the latest and having insights. Take like our software lending business. We have looked at so many software companies, thousands of software companies in every imaginable niche. We have specialists in cyber, we have specialists in payments. And so our knowledge base is of value, both to making the decision, but importantly, in someone picking who do they want to finance with. They're saying, you know what, I like financing with Blue Owl. You actually help me. You know, in fact, you've probably seen companies we haven't seen, industry trends we might not be tuned into. So together, actually, you're helping us make a better decision. I'm not overstating our role. These PE firms are phenomenal at what they do, and they have incredible knowledge. But having a partner who also has knowledge and understands them and their business has value you will pay for. So I think to me, that's kind of how you kind of pull it together around scale. In some cases matters a lot. In some cases, it probably doesn't.
The other aspect of scale that I imagine is on a lot of people's mind is, particularly in private credit, there's been significant amount of growth, more capital's come into the space. At the top end, there's only a certain number of firms who can A, achieve that scale, but B, service those larger companies. What has that done in terms of how you have to underwrite deals, how you have to compete to win deals? Do you have to also go lower on return on yield because you have to provide better terms? What are the dynamics of scale manifesting itself as the space grows?
So private credit has surely grown, but it's pretty interesting. It's really a pyramid-shaped industry. Maybe many are, but private credit, particularly, the top of the pyramid, the handful of us that are the largest providers to the largest users, it's mostly the same people. In fact, it's all the same people over the last 5+ years. The big have gotten bigger. We've gotten bigger, and so have the handful of peers. There've been a lot of new entrants, but the entrants are in the base of the pyramid, and that may be a perfectly viable business. But the ability to move from the base to the high end, we haven't seen it, and I think there is a reason. The reason is this: we meet the needs, as you noted, of the largest borrowers. And we've built the trust and respect partnerships with those firms. And candidly, to your point about spread, of course, spread will always be a function of the environment, and it undulates for us. There's moments where the public markets are wide open, then sure, spreads are going to be a little bit narrower. If markets are fully closed, spreads are going to be a little bit wider. There may be a moment in time where one firm's a little more aggressive than another. Great, that's how markets work. But at the high end of the market, with the handful of people that participate, two things are true. One, we're meeting the need. A large scale user only has to make a call to Blue Owl, and they will have their solution. Now, there's a couple other people they can call as well. And by the way, oftentimes they'll put us together and say, you know what, you both would be great to have, so why don't I put you together? So in this group of large cap lenders, their needs are met. So it's not an unmet need. Start there. Second, our cost of capital isn't very different. So to your point about spreads, it's actually a very natural band that exists. And this is a very good fact for durability of the market. There's a very natural band that exists. Our cost of capital, as I said, probably not that different, I would imagine, from other large lenders. And the people's willingness to pay has a certain, again, even though there's thousands of them, there's just a certain limit to what someone's going to pay to borrow money to buy a company. And so there's kind of this natural kind of ceiling and floor. The ceiling is kind of the point of pain where someone says, I'm just not paying that much money to borrow. And there's a floor, which is, look, that's my cost of capital. And you may be able to go find it in the public market cheaper, and you can do that, and that's okay. And if that's what matters to you, in fact, you should. Like, if the only thing that matters is cost of capital, we're probably not your market. We go to people and say, I just want to tell you, it's going to cost you more. The document's going to be far more rigorous, and the diligence is going to be far more invasive. I mean, that's not like a winning pitch unless it comes with, but I'm going to give you a predictable result on a date certain, term certain. It's going to be private. You get to manage your company with us as your partner for the next 3, 5, 7, 10 years. And indeed, that last point, partner. We're in it together. We lend you the money. We're talking together, and we're here to help your success because your success is our success. Yeah, it's not selfless. So that proposition does work. Someone who values those, what I call the 3 Ps, predictability, privacy, partnership, they'll pay for it. If someone doesn't care about that, they're probably not our customer. So all that's a way to say that I think there is this sort of this natural place we will all porpoise in that has a bottom end that just says, look, that's what it's worth to us. And if it's cheaper for you and you want to go somewhere else, then so be it. And at a top end, people just say, I'm just not going to transact.
I think that relates to a trend that's happening in private credit in particular is less syndications, more firms with certainty of capital that are doing deals on their own. Is that a secular trend in your mind?
Yes. It is a secular trend toward, and this is where that term one-stop shop in my version comes into, which is people like the convenience of working with a smaller number of people and with people or a person, a firm that they know. Now, in credit, that may often be more than one. To be clear, like we're very happy to be part of a small group with other like-minded, highly sophisticated lenders. And actually, as a portfolio management matter, we don't ever want to be hyper-concentrated. One thing about credit, unlike equities, it will never, ever, ever be the case that high concentration is a good idea. Back to only getting paid back or not. And so it's not a business where you want to be concentrated. So actually, when a sponsor says, well look, I want you to lead it, but I'd like these 2 firms in it, that's not a bad thing. We're trying to risk manage our portfolio. I'd rather have 2 pieces of paper, if I thought they're of relatively comparable quality, than double in one. It's quite clear in credit. That may not be, in fact, probably is not true in equity, where there's a lot more of this, yeah, but what if that's the one winner? There's no one winner in credit. We're supposed to be right almost every time. We've originated well over $100 billion in credits. Our running loss rate has been 11 basis points a year. So it means we have to be right. Again, obviously, you do the math. Well over 99% of the time.
In your mind, does that maintaining that loss rate get harder as more capital comes into private credit? And I understand there's also different aspects of private credit. ABF is an area that's growing. That's why you acquired Atalaya. But does that loss rate get harder to maintain as more capital comes into private credit? Or are we also seeing so many companies stay private longer that that makes up for that supply-demand imbalance?
So the ability to be bigger and have more capital has actually been causal, not just correlated, right way causal with improved credit performance. Now, is there a limit to that statement? Let me unpack that for a minute. The fact that we've been able to raise pools of capital that are now large enough to fulfill the needs of the largest financing demands by the largest companies with the most well-capitalized sponsors is what has led to the very low loss rates. Our average company has about $250 million of EBITDA. They're big companies. And we lend on average 40% loan to value. So the scale is the insulation. Those companies are durable. Look, we're in a world right now where things are changing fast. The durability of a business with $250 million of EBITDA and a well-capitalized, sophisticated owner relative to, cut it down by 10, a company with 25 million of EBITDA and a very high quality owner, but not as sophisticated, certainly not as well capitalized. That's all the difference in the world as a lender. The former is sort of obviously superior to the latter, and it shows. So actually, scale has driven improvements in credit quality. This idea of it's a good environment, but 11 basis points of loss is way below anybody's expectations, and it's been a decade now. Again, a pretty good decade, but not a flawless decade. I mean, rates are up, rates are down, a pandemic, the run on the bank at Silicon Valley Bank, wars in the world. I mean, it's not exactly been quiet. It's been good economy, so I don't understate it, but I think all that actually has been caused by the scaling. Now, is there a limit to that? Sure, by definition, now to go to the earlier point, supply and demand. If supply so overwhelms demand at any moment in time, well, then that's an unhelpful development in terms of scale. But you hit on a very important point. What's happening right now is more and more companies are choosing the private route, whether in total as private companies or private financing over public financing. So as much as the story in the public's eye has been about, oh, a lot of capital has come into private credit, there's more addressable market than capital that's come in. We're actually in a very balanced state. Again, any given quarter might favor one or the other, but if you look at like asset-backed, it is a nascent moment. And yet people are realizing the same thing. Rather than finance just one-off when the public market's available, I'm going to find a partner. And so we're lucky enough to partner with people like SoFi or Pagaya. And those are partnerships that run forward, not just, hey, it's a transaction.
And are going to grow. I mean, I think that actually ties into something you said earlier, which was we've tried to orient our business around themes and verticals that we feel like, A, we can be best in, and B, that we understand really well. And if you think about that, like ABF is one such area where massive growth trend. You've done that in a bunch of different areas, though. Like when you think about your firm, you've oriented the strategies that you have around all these megatrends, whether it be digitalization, AI, data centers, private credit, alternative credit, ABF, GP growth of alternative asset management. How much of that was by design versus these ended up being trends that kind of came about as you were building the firm?
Well, look, let's say it's both. I mean, that's to say, to call it, oh, we were just perfectly prescient in every, that would be silly. But there certainly is method. And there certainly are reasons we've gone after the markets we have, and they relate to what I described about imbalances between supply and demand of capital in favor of the supplier. Places where a user of capital will value something about who provides it. That's an attribute we're looking for. Certainly just overall growth. Obviously, if I have a growing market, there's more room to innovate and maneuver and provide solutions. So there's a lot of thought that's gone into where we've gone. And I'll say it this way, my co-CEO, Doug Ostrover, phrases it the way, and he's been so good at this, which is the Wayne Gretzky, look, skate to where the puck is going to be, not where it was. And that has been kind of a nice encapsulation, I think, of what's been our motivating approach, our philosophy from the beginning. It's not about where it used to be. What we're trying to look ahead and see is, but where's it going to go from here? Let's go skate over there. And so in that regard, I would say that's been the, if I was going to give us credit for something, I think we've spent a lot of time on that question, which is where's that puck going to go? And what kind of investment in people, back to like the wealth channel, does it take to win? And win means deliver the best results in that area. And that's really been why we've been able to pick up on very early on this pivot of private credit from lender of last resort to lender of first choice, with joining with Mark Czar to take real estate and say, well, wait, this is a very financeable tool. There's trillions and trillions of dollars of assets on the books of investment grade companies. Why shouldn't we be able to help them unlock it? That's a big opportunity, and they care who they work with. GP stakes, who are you going to marry? When we partner with someone, decade, 15 years. So who matters? So that's what we try to get out of trends and places people will value who we are.
So you talk about skating to where the puck is going. When you think about your business, where is the puck going?
A few things. I think the puck continues to go toward a world that is more private than public because it works. I mean, at the end of the day, it gets down to, does it serve its end, so to speak? And private solutions have scaled. They're predictable. And a lot of companies are saying, I want to be able to think longer term than the market lets me in a day trading, quarterly reporting cycle. So one, I think that puck continues that direction. That's not new. Other places, though, the puck is going is other markets that have not yet adopted private solutions and have the same attributes. ABF is the perfect example. It's a huge market. It's bigger than the direct lending market, depending what pieces you put into it. It's a huge marketplace. Very limited penetration by private solutions. Very similar attributes. Traditionally, people have used liquid public markets, banks as intermediaries. So the playbook is, we've seen this movie. It doesn't mean it's identical. It's a bit like history, rhymes, doesn't repeat. But we can quite clearly see a similarity. Going to people and saying, look, you can keep transacting that way. And when markets are good, you'll have access to capital. But if you would like to have a partner that's going to give you access to capital in the glorious moments and the more challenging moments, which is going to create more value for you, that's what we're here to do. And so the puck is going to that place in ABF. It is going to, hey, I do value a private solution. And by the way, it creates more investment opportunities because in that world, you can actually pick a lot of different gradations of, well, what level of risk are you looking to take for what kind of return, right? Because there's investment grade solutions. A lot of them are investment grade, and there's non-investment grade and the full range in between. So Atalaya, it's not a new idea to them. It's a hot topic today that's about to, I think, hit this inflection point, but they've been doing it for almost 20 years. They have data on 100 million different businesses and consumers, all of which you need to inform that decision. But I think we are going to see the market go from single digit, private as a share of asset backed, following a similar trend line to what we just saw in corporate private credit, where now it's, it depends on who you ask, but 25% of the market.
Fintech is catching up to private market in that regard, right? Like working with firms like Klarna or PayPal, things like that on the ABF side. But that's what the Atalaya of the world do.
That's exactly right. It's catching up, and it actually is a little bit of a marriage made in heaven in so much as no fintech company wants to be a balance sheet company.
Yeah,
our business is to be the balance sheet company. Price it right, manage it right. That's supposed to be our skill. So if their skill is origination and underwriting using much more data-intensive algorithmic work, and then we marry that with our data-intensive capabilities to match, analyze the pools, and then put it in our private storage, that actually is a really great ecosystem.
Yeah.
They don't want to be a balance sheet business. They shouldn't be balance sheet businesses.
You mentioned the word origination. I want to tie that to something you said a few minutes earlier, which was that you're trying to find those imbalances and really match what clients need. You've done that on the investing side, but you've also done that on the LP side. And the way I want to talk about that is in the context of permanent capital. Yeah, I think you have 91% of your business is permanent capital, roughly speaking.
Yep.
Why is that?
That's pretty precisely speaking. Well said.
Why is that so powerful for the business?
So it's very powerful for the business, and I'll describe it for two reasons from two different perspectives. Most importantly, actually, it's powerful for the people we provide capital to, because our decision-making with permanent capital is not artificially driven by a piece of paper that says, this is the investment period, this is the investment period. You must realize all your assets by this time. So what it unleashes is this artifice of, okay, you have 3 years to invest, 4 years to hold it, 2 years extensions, which means you're obviously going to make decisions that are, logically so, that partly reflect that set of very artificial constraints. So importantly, and this from early on, when we went to borrowers, we could go and say, we don't have a template that you have to borrow from us with no call for 4 years, and because otherwise the money comes back too fast and we can't get a MOIC, and all these things that are very logical if you're given that set of constraints. So the permanent capital allows us to go and say, tell us what you're trying to do. And importantly, action speaking louder than words, when we say we will be your long-term partner, we can point to it. It's not you're counting on us hopefully to raise the next fund. As you said, 91% of our revenues come from permanent capital. So, we are your long-term partner if we continue to earn the right to be. We'll have the capital if you have the need. So a lot of this goes with, again, this idea of how do I get someone to pay for something more than capital? Okay, I know you're going to have the capital. We used to do loans that we knew were going to be and we still do, very short dated. A typical fund will not do that loan because they've used the commitment. And they're not going to use their commitment to have it get paid back in 12 months. If 12 months is the answer you need in our permanent pool, no problem. You'll use it. I mean, it takes a lot more work for us, but then you'll pay it back and we'll put it back to work. So it may put more pressure on the GP to invest in more people and more origination, but that's okay. That's our problem. For you as an investor, you want me to just make the best loans, regardless of whether they fit in this kind of strange time frame or not. So that's why. Now, as a business matter, it's safe to say it's a good business for us. Obviously, it makes our business more repeatable, makes our own, Blue Owl as a GP a better business. Again, I'm not oblivious to that. Again, we can do well and do good. So
I think that's a really interesting point, though, because when I think of you talk about your business, how you've constructed your business, both in that context, permanent capital plus the business units that you've built, how you've acquired firms. I saw an interview with Jaden Daniels recently where he was asked if you could build the perfect quarterback, like whose arm would you have, whose brain would you have, whose body would you have? And I feel like there's some similarities there in that regard. I mean, this firm is only 8.5 years old or so, right? You started Owl Rock in 2016, and almost 9 years later, you're the size and scale of where you are. Can other firms do what you did?
Well, first of all, I'm going to take it as very high praise, the analog to Jaden Daniels. Of course, I'm very partial, but wow, what an epic quarterback and what an epic person. So thank you for even the analogy. Look, we did have in a way, the benefit of doing what you just described that's rarely available, which is to say, well, if you could build it to purpose, what would you make it look like? As opposed to, here's what it was, and now I want to try to move it this direction. Because we all know that moving things is harder than building them. I mean, it's harder than building from the ground up. Ground is a hard thing to do, but at least to make it purpose-built. So we did have the opportunity, which will present itself periodically in the world. And we were lucky because we picked a good time. We got a lot of tailwinds. We had some right ideas, which you and I have been talking about, but we benefited from that. And so, are we the only ones that can do it? Certainly not. But it does take a confluence of an environment and a moment in time with capital flows and wealth emerging as a channel, and this idea of, hey, we want to make private credit a lender of first choice, and we want to deliver in alts. It's not about the highest octane results. It's actually about lower risk managed results. And those are going to be more periodic. So I'm sure other people are going to build incredible businesses. I have so much admiration. I love business. But, one thing that for me has always motivated me through the 30 years of being in investing, one thing I really love is it's a business about other businesses. So I'm lucky because I get to spend my job. Every day is not a joy, but I love my work because every day I get to think about, well, what's changing? What's new? Is that a good business? What makes it a good business? And I like that, right? Someone in this incredible marketplace is always innovating. So honestly, yeah, I'm scared of the next person doing that. I think that's good. I mean, as our firm, we always say, can never be complacent. We have no right to anything. We have to get up every day, deliver outstanding results, measured both in actual investment outcomes, service, support, accessibility, and that gives us at least the right to keep trying. I think we'll do it. I feel good about that, but complacency kills. And that's, it's how we got to create our business, and other people will create their businesses when people become an incumbent and act like an incumbent. You can be an incumbent and not act like one. And that's what I guess we're committed to trying to do.
I want to end this conversation on the topic of joy. You mentioned Jaden Daniels and why you're partial to him. You're involved with the Commanders, as you are with the Tampa Bay Lightning. And you've created a lot of joy for the DC area, for sure. But I think there's something so interesting about the intersection between sports and business. A lot of that centralizes around culture. And as you think about how you've built Blue Owl, you think about the Lightning, which have built an incredible culture and team. The Commanders completely changed their culture in the course of a year. What have you learned from both ways? So business building and then applying that to the culture of building a sports team where everything is so public on a daily, weekly basis. And then vice versa too, seeing what happened with the Commanders. I mean, it's just so incredible to see the belief that was instilled in that team, the mantras they used. Anytime, anywhere, anybody, right? Like, how has that translated to how you've then run business like Blue Owl and growing this business?
The sports experience has been great. And of course, we could talk about the fun part of sports, and there's fun parts. But you are right, and this kind of ties to this always learning in different businesses. So first off, Josh Harris and the team they're leading and the players at the Commanders, like, they've brought joy to DC. They've brought joy to me. I've been lucky just to have a front row seat, so to speak, as a very small part of it. But there's a lot of intentionality to that. It has been incredible to watch, and it's exactly where we started this conversation. Culture matters. And when I look at what Josh and the leadership team of the Commanders have done, and again, I've been lucky enough to be up close to it, it has been about building a culture of values, a culture of respect, a culture of performance, and it shows. And then actually very similar to any business, there's also an element of good fortune, right? Anyone would say, they were so, of course, right on Jane Daniels, and they said it. They said, that's the quarterback we want. So they were right. But it'd be impossible not for anyone to say, oh, and it turns out he's generational. Nobody could know that until, the lights are on and, the clock is ticking. So I think that there is that same combination of intentionality and culture and getting people to work together toward a result and embracing and respecting your fans, and then some very good fortune.
Sure, good fortune, but I think the good fortune was not an accident, right? Like, the team always talks about winning time moments. That happens when you wire your brain to think like that.
Yeah.
And I imagine you're doing the same at Blue Owl in terms of you're wiring your team to think a certain way.
Yeah.
How you operate, how you work with clients. You're spending multiple days here with firms from the wealth channel. I mean, that's an investment.
Yeah.
You're deciding to do that.
Yeah, you're right.
And that's, I imagine those things go hand in hand.
You're absolutely right. It is, you've got to be committed to the outcome and committed to your culture. You can't say, well, that didn't work today. Let's do something different. You got to decide. You have to have a North Star. And I do think that kind of culture and your values are your North Star. And it's already showing in the Commanders. It's not like the Tampa Bay Lightning, they're studying the corollary. They have been a phenomenal culture, for years and years now. And between the people that have led it, and it's this incredible team between Jeff Vinnick and Steve Griggs and Julian Brisbois and John Cooper, like, they're incredible leaders. And they've built a culture that's about winning and respect and caring about, their fans. It's like, it's an entire community. And we're lucky to be a part of that. But there's an example of an incredibly powerful culture, and it's worked. They've been in the playoffs 9 out of 10 years and won 2 Stanley Cups in the last 10 years. I'm just scared about.
Well, you may say that, and kind of joking around about it, but I think this is such a great way to wrap up this conversation, because it really ties the most important theme together, which is people, right? You're both of these businesses, sports and alternative asset managers, investing, they all come down to people.
They sure do. They come down to people. That's what you have. You have players you put on the field, and you have game plans, you have plays. And by the way, maybe to push it, plays evolve, right? You have to be making real-time decisions. Same thing, right? You have a playbook, but you can't just run them mechanically. The winners are the people that are fluid and have a playbook, have a plan, but also know when to vary from the plan. And that's actually very much the way we intend to skate to where the puck is going, with Blue Owl. We have a plan. We have a clear plan. We have a great team, and then we're going to adapt.
I love that as a way to wrap this all up, because it ties everything together. So thanks so much, Marc, for coming on the Alt Goes
Thanks, it was a real treat. Real pleasure.
Pleasure to have you on. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot, and have a great day.
We're going